Imagine working hard for years in the United States, saving money, investing for your future, and building financial security, only to discover that a new tax rule could quietly take a bigger share of your savings without you even realizing it. If you are a green card holder, the tax rules coming into focus around 2026 could affect how much of your money you actually keep, whether you live in the United States or even if you move abroad. Many permanent residents believe that taxes only apply to income earned inside the country, but the reality is very different. Under rules enforced by the Internal Revenue Service, green card holders are treated as full U.S. tax residents, which means your income and investments worldwide can be subject to reporting and taxation. That includes your job income, your savings accounts, your foreign investments, and even property you own outside the United States. What makes this even more concerning is that many people don't realize how small changes in tax policy can slowly reduce long-term wealth, especially for immigrants who are trying to build a stable financial future. A few extra percentage points in taxes may not sound like much today, but over time it can mean thousands or even tens of thousands of dollars lost from your savings and investments. And the biggest problem is that many green card holders only find out about these rules after they have already made costly mistakes. In this video, we are going to break everything down in simple language, so you can clearly understand what is happening and how it could affect you. You will learn how taxes really work for green card holders, what changes are being discussed and implemented around 2026, and why these changes matter for your savings and investments. We will also talk about the people who are most likely to be affected, including immigrants working in the United States, green card holders living overseas, and investors who have assets in multiple countries. Most importantly, you will learn practical strategies that can help you protect your money and avoid expensive tax surprises in the future. Whether you recently received your green card or have been a permanent resident for many years, understanding these rules could make a major difference in your financial future. By the end of this video, you will have a clear picture of what these tax changes mean and what steps you can take to keep more of your hard-earned money. How taxes work for green card holders. If you hold a green card, you might think that US taxes only apply to the money you earn in America. But that's not the case. The moment you get a green card, the Internal Revenue Service considers you a US tax resident. That means all your worldwide income, including salaries from abroad, rental income, investments, and even business earnings, must be reported to the US government. For example, imagine Ahmad, a green card holder who moved to Canada for work. He earns $70,000 in Canada, thinking he is only taxed there. In reality, he also needs to report it to the IRS, and depending on tax treaties and credits, he might owe additional taxes. Question: does this mean I'm taxed twice? Answer: not always. There are tax treaties and foreign tax credits to prevent double taxation. But without careful planning, many people still end up overpaying. Another common example is Maria, who invests in European stocks. Even though her brokerage is overseas, the IRS still wants to know about it. This worldwide taxation rule is what trips up many permanent residents, who assume that only US-sourced income matters. The key takeaway is simple. Having a green card isn't just about living in the US. It's about being financially accountable to the US government, no matter where you earn money. This chapter sets the stage for understanding why the 2026 changes could be significant. What changes in 2026? The 2026 tax law introduces several rules that will affect green card holders more than ever before. One major change is stricter reporting on foreign accounts and investments. For example, if you have a bank account in Germany or an investment in India, the IRS now requires more detailed disclosures than before. Failure to comply can lead to penalties of thousands of dollars. Question: why is the IRS doing this? Answer: the government wants to close loopholes and make sure that income earned anywhere in the world is properly taxed. Another significant update is changes in retirement account taxation. Many green card holders living abroad use foreign retirement accounts or invest in US 401ks. Under the new rules, contributions and withdrawals may now face unexpected taxes or reporting requirements. Consider Rafi, who contributed $10,000 annually to a US 401k while living in India. Under 2026 rules, Ravi must report contributions and earnings differently, and misreporting could trigger penalties. Similarly, foreign investments in stocks or mutual funds may see higher compliance burdens and tax documentation requirements. The bottom line is clear. Even if you don't earn more money, these reporting changes alone can increase your tax liability and create headaches for those who don't plan ahead. How it affects your savings? You might ask, Okay, but how does this affect my actual savings? The answer: more taxes, more paperwork, and less money left in your accounts. Even a small increase in taxable income or missed deduction can compound over years. Take the case of Lena, a green card holder living in Mexico who earns $50,000 from rental properties. Before 2026, she could claim some deductions easily and had minimal reporting. With new rules, Lena must now track each property, report foreign rental income in detail, and may owe more taxes than before. Over 5 years, this could cost her $15,000, $20,000 if she doesn't plan carefully. Question: can't I just ignore it if I live outside the US? Answer: no. Ignoring it can lead to steep fines, interest charges, and even audits. Another example is one who invested $30,000 in European stocks. Even though the investment is abroad, the IRS counts capital gains under worldwide income. Without proper reporting, his tax liability could jump unexpectedly. The main takeaway is that savings and investments are now more exposed to US taxation, and ignoring this will reduce the actual wealth you thought you were building. Biggest mistakes green card holders make. Many green card holders unknowingly make mistakes that cost them thousands. The first mistake is assuming foreign income doesn't matter. We already saw Lena and Ahmed's examples. This is by far the most common trap. Second, not tracking foreign accounts properly. The 2026 rules now require precise reporting of balances, dividends, and gains. Missed reporting can result in fines of up to $10,000 per unreported account. Question: what about investments in my home country before getting a green card? Answer: the IRS may require reporting depending on whether you became a green card holder while still holding those assets. Transition planning is critical. Third, poor retirement planning. Many think contributing to a foreign retirement fund avoids US taxation. With 2026 updates, these assumptions may no longer hold. Fourth, delaying tax filings or ignoring penalties. Small mistakes grow into large liabilities over time, often with interest that accumulates silently. Lastly, many fail to seek professional advice. Green card holders with international income, investments, or business activities should consult tax advisors familiar with both US and foreign regulations. The lesson: ignorance is expensive. The mistakes are avoidable if you understand the rules and take proactive steps. Who is most at risk? Not all green card holders are affected equally. High-risk groups include those living abroad, earning multiple income streams, or investing internationally. Take Fatima, a permanent resident in Canada who runs an online business selling software to US and Canadian clients. With new reporting rules, she must account for each client's payment in detail. Mistakes could result in audits or penalties. Question: are people working only in the US also affected? Answer: yes, but the risk is lower if all income is domestic. Still, investments, dividends, and retirement accounts can trigger new reporting requirements. Another example is Daniel, a green card holder who owns rental properties in Europe. The new law affects how he reports foreign rental income, and even currency fluctuations may now impact his tax calculations. High net worth green card holders with complex portfolios are the most exposed. However, anyone with overseas investments, multiple bank accounts, or cross-border business activity should assess their risk now rather than later. The key point: knowing your risk profile helps you prioritize planning before 2026 hits. How to protect your savings? The good news is that there are steps you can take to protect your savings and minimize exposure. First, understand your tax residency. Knowing that a green card triggers worldwide taxation is the foundation of planning. Second, track all income and investments carefully. Use spreadsheets, accounting software, or professional services to avoid missed reporting. Question: can I legally reduce my taxes? Answer: absolutely. Strategic planning, using tax credits, deductions, and US foreign tax treaties can reduce liability. Third, invest smartly. Some retirement accounts and investment vehicles are more tax efficient under the new rules. For example, contributing to certain US-based tax-advantaged accounts may save money if properly reported. Fourth, file accurately and on time. Late filings or incorrect reports can trigger penalties that wipe out your savings gains. Finally, consult a qualified tax advisor. Green card holders with complex international finances should work with someone experienced in cross-border taxation. For instance, someone like Ahmed could have saved thousands by planning his Canadian income against US tax credits. The bottom line is simple. Proactive planning, careful reporting, and professional advice are your best tools to protect wealth under the 2026 tax law. Now that you understand how the 2026 tax changes affect green card holders, it's clear that this isn't just another boring rule. It could directly impact your savings, investments, and financial future. We've covered how taxes work for green card holders, what the new 2026 rules entail, the real effect on your savings, the biggest mistakes to avoid, who is most at risk, and most importantly, how to protect your money before it's too late. The common thread: knowledge and action are everything. Ignoring these rules or assuming they won't affect you can cost thousands, while taking proactive steps now can save you tens of thousands over time. Ask yourself, are you tracking all your income, investments, and foreign accounts? Are you aware of the retirement or investment strategies that could reduce your tax exposure? If not, this is the moment to start acting. Even small oversights can grow into huge liabilities under the new law. But the good news is, with the right planning and guidance, your green card can continue to be a pathway to financial opportunity rather than a source of unexpected tax headaches. If you found this video valuable, don't just watch. Take action today. Like this video to show others why green card holders need to be informed. Subscribe to the channel for more critical updates, and hit the notification bell so you never miss a step-by-step guide to protecting your wealth. And here's something important. In our next video, I'll reveal the top 5 mistakes immigrants make that cost them thousands in taxes every year. Mistakes that most people don't even realize they're making. Make sure you watch that one, because it could be the difference between losing money and keeping your hard-earned savings safe. Remember, knowledge is power, but action is wealth. Don't wait until 2026 catches you off guard. Start planning now and secure your financial future.